Hey, what's up guys? John here. 2 weeks ago, I did a video on this channel saying that bank bail-ins are going to be happening and banks are going to start collapsing. It's right here. 2 weeks ago, 30,000 views. Now, what ultimately happened the following 2 weeks is the last 7 days, we've seen 3 banks fail. Now, what we are going to see in 2023, I believe, is going to be massive bank runs. We're going to start to see more of these situations unfold. We're going to start to see consumers start to bring their money from their banks to their house. Am I telling you to do this? No, I'm not. Not saying this at all. But what I am saying is that we are going to start to see extreme distrust in the system, and we're going to start to see people being very weary about trusting one specific bank, one institution with their entire life savings. In this video, I'm going to break down what's really going on behind the scenes so you can make smart and informed decisions with your finances. Crazy times we are in, but we are just getting started. In the last couple of years, I said, 2020 is going to be crazy, but 2021 will be worse. And 2021, I said 2022 is going to get crazier. And this year, 2023, is going to get crazier. 2024, 2025, it's just going to get more and more insane. We're not going back to normal. This is the new normal. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really going on. Take a look at this. And by the way, today's video is sponsored by Great Credit Fast, my credit repair company. We help new investors fix their credit so they can position themselves to potentially do 0% balance transfers, get debt free, potentially invest in real estate. We help people fix their credit. So if you need help, we'd love to help you at greatcreditfast.com. You can give us a call at 561-430-5900. Take a look at this. So 2 weeks ago, 30,000 views, global banking collapse confirmed. But this situation is very fascinating. People always say, John, but if you have less than 250,000, you're FDIC insured. People don't realize the FDIC only has 128 billion. 128 billion. That's nothing in the scope of the amount of deposits that we have. So right now, at the end of 2022, the FDIC reported that its deposit insurance fund has a balance of 128 billion, about 1.27% of the total insured deposits. While just SVB, they had a total of 209 billion in assets and more than 175 billion in deposits. So just this one bank, this one small bank, had more money than what the FDIC is supposed to cover nationally in the event of some type of situation were to go down. But we start to look at these headlines. Crypto-friendly lender Silvergate collapses. SBV collapse, everyone knows about that. Silvergate. This bank also collapsed. Risky bet on crypto and run. Signature Bank. We're starting to see First Republic dives. We're starting to see stocks crash, bank stocks crash. But this is where things start to get very, very fascinating. Now, a lot of people the last couple of years made a ton of money in real estate, investing in real estate. Banks made out, like bandits with their fees. Mortgage lenders made just a ton of money. Same with real estate agents. The economy was booming. But what happens when these loans start going bad? Deposits start to really get pulled out of banks, and then banks are just walking liabilities. Well, we're going to start to see tons of these SVB type situations unfold. And here's what I mean by this. So if you look at the top 10 banks, Key Bank, for example, top lender in the list, Cleveland, Ohio-based Key Bank closed $38.2 billion in commercial originations during 2020. Right, CBRE, another $40 billion just during that 12-month period. Walker and Dunlap, Barcadia. You start to look at these numbers though, like Wells Fargo. They're sitting on $2 trillion in assets. Wells Fargo reported a total portfolio, commercial real estate, $110 billion at the end of the third quarter this year. Marked a $1.8 billion increase from the previous quarter. Newmark, but all these different banks are issuing these commercial loans over the last couple of years. People buying these deals at a 3 cap or a 4 cap, meaning that if you were to buy these properties all cash, it would produce 3 to 4% return on the purchase price. So $1 million property, 3 cap, be $30,000 a year, right? So like $2,500 a month. What does this really mean when you start to see vacancies increase, mortgage rates double from 3% to 7%, insurance, property insurance and property taxes continuing to climb? It means that you're going to start to see a lot of these quote unquote deals become horrible liabilities that people are going to start walking away from nationwide. And as this begins to happen, we're starting to see more and more layoffs. This is just starting. If you look at 2022, for example, tech layoffs 161,000. 2023, the first 3.5 months, we're at 128,000. So probably by the end of this month, we will be at or very close to the entire layoffs that took place in 2022, right? So we're starting to really move, and now what people are doing right now is taking adjustable rate mortgages. They're doing this to try to save a little bit in interest up front, hoping that interest rates are going to go down and they're going to be able to refinance into a 30-year fixed rate mortgage later. But the reality is that is purely speculative and extremely risky, and if interest rates do not go down, then you can have a situation where a mortgage payment go from $2,000 or $3,000 a month to $4,000 or $5,000 or $6,000, depending on wherever the interest rates are at that point in time. And if rates continue to climb, that property likely is not going to have any equity in it, because as interest rates rise, property values tend to get punished because the borrowing costs are just too high. So this is a very, very big trend. But as this is happening, we're starting to see 270,000 home buyers who bought in 2022. They're starting to get underwater on their properties. But this is fascinating. More than 40% of all U.S. mortgages originated between 2020 and 2021. 40%. And so when you look at the average down payment in America is 6%. How much is the average down payment on a house? The average first-time buyer pays 6% on a home price. And repeat buyers put 13%. We call it 10% down, 10%. Well, if you were to sell a property, you're paying 5% commission, 2.5% to the buyer's agent, 2.5% to the listing agent. You have closing fees, the transfer taxes. I mean, maybe there's 7% in actual fees. So if you're putting 10% down, then you only have a 3% margin, And as interest rates go from, 3% to 7%, there is no margin. Right? A lot of people are underwater. When you're talking about 40% of the entire U.S. mortgage market purchased at the height of the market, and this is all held by banks, what does this mean? Well, it means that people are going to be in trouble, and it's already showing it right now if you look at credit cards. Credit card debt surpasses savings. So people have more debt than they have savings. Right now, the savings rate, it was about a week ago, $1 trillion. Now it's a little bit less, but credit card debt is over $1 trillion. Credit cards over $1 trillion. Ken Griffin, who made $2 million an hour, $2 million an hour last year, one of the wealthiest hedge funders in America, he came out and said that consumers have $1 trillion in excess savings, but they're basically burning $100 billion a month. $100 billion a month. So tell me how banks become strong or stable in 2023 if they're sitting on tons of bad mortgages on commercial and office space, residential mortgages, credit card debt. They're sitting on all of this debt and liability, and consumers are withdrawing their funds to make good on their expenses. Well, look at right now, auto loan delinquencies reach highest rate since 2010. And gold is starting to move upwards because people are starting to get a little bit more weary of what's really going on. But this is fascinating. So the T-bills, 3-month treasuries, 4.87%. Why would you put your money in a bank at 0.5 point or 1/4 point when you can get 4.87% and not take the bank risk? Well, you're going to start to see that. What's going to happen? People are just continuing to take their money out and go into T-bills, which is even more weight on the banks. And Jerome Powell some people are banking that he's not going to hike rates anymore. I don't think so. I think he's going to continue to increase interest rates. And as he does this, what's ultimately going to happen? The value of the liabilities that the banks are holding becomes worse and worse and worse, right? Things are going to get harder. And he's talking about that they're prepared to speed up interest rate hikes. And this was last week on the 7th. Last week on the 7th, as they were talking about job growth of 311,000 jobs. So here's what I think is going to happen. I believe we're going to start to see more bank runs. I think we're going to start to see bigger banks, not just the SVBs and the small banks. I'm talking like one of the big banks, potentially a Bank of America or a Wells Fargo or a Chase. One of these large banks I could see going under. And the reason for this is because it doesn't take much. If people get a little bit weary and a couple smaller banks start to go down, people will start going to the big banks for the short term. People start moving their money over there. However, as the economy starts to crack, they're not going to trust those banks either. And so what's going to happen? People are going to start getting more and more paranoid and cautious and withdrawing their funds at a faster velocity than what Ken Griffin was suggesting. So my belief is we're going to see some real problems in this economy. During the problematic period is when you make a ton of money. Most great fortunes are made during the panic. So I'm not saying this to scare you, but if you're just looking at pure fundamentals, which is, on this channel we talk about personal finance, the fundamentals, the banks are in big trouble. Banks are in very, very, very big trouble, and so is the FDIC. They were even talking about this 3 months ago, talking about bank runs. Think about that. 3 months ago, they had that video they put out talking about bank runs happening this year, and then a couple small little banks go down. This is just the start. What do you think about it? Drop it below, hit the like button, subscribe here, and subscribe to my second channel, interactive call-in show and a podcast. And if you need help fixing your credit, we would love to help you at greatcreditfast.com. This is the time to fix your credit and to get out of high-interest credit card debt. You want to do that because as they hike interest rates, the cost to borrow money is going to get more and more and more expensive on credit cards. And in addition to that, as the economy starts to shake a little bit more, you're going to start to see a lot of these introductory offers, these 0% balance transfer offers start to go away. So this is the time to do a balance transfer. It's time to fix your credit. We'd love to help you at greatcreditfast.com. Give us a call at 561-430-5900. Subscribe on Instagram for short form content. Catch you guys in the next video.